The last time this committee met virtually was in October of 2020. And the last time this committee met in person, hard to believe, was December of 2018. So it's been 4 years since we've actually seen you all. And we are going to do our best not to let another 4 years pass without seeing you again. And we're going to try to resume annual meetings of this committee, which really has enormous value to us in an area that is of vital importance to the FDIC. At the end of the day, our ability to manage the orderly failure of a systemic financial institution will probably be the ultimate credibility test for our agency, and how our agency is viewed will be determined by how we handle that challenge. We have a full agenda, so I'm not going to take more time, but we've really broken the morning into 3 sessions that I think will be of interest to you. The first session is going to focus on our efforts to integrate our supervision and resolution responsibilities. In the second session, we're going to focus on our 2 key resolution priorities, our ongoing work for systemic resolution under Title II of the Dodd-Frank Act and our utilization of the Orderly Liquidation Authority. And we're going to focus in particular on our work around increasing transparency and how we think about Title II resolution and communicating with financial markets as well as the public to try to establish better understanding of what we do. And that is really not a simple task, as you all probably understand better than most. What is a key priority for us, which is enhancing our ability to manage the failure of large banking organizations below the GSIB level. It's really a very distinct resolution challenge for us from the GSIBs, in many ways as great as the GSIB challenge. And because we were so obsessed with developing a capability to manage the failure of GSIBs, that was not the first thing we turned to was not the large banks. And then we woke up and realized the failure of one of these large banking institutions could really be an enormous challenge with financial stability implications. So we've devoted a lot of time. That's a priority, I think, for all 3 of the U.S. banking agencies, the Fed and the OCC, as well as the FDIC. And as you may know, the FDIC and the Fed issued a joint advance notice of proposed rulemaking to seek public comment on the possibility of establishing a long-term debt requirement for our largest banking organizations below the GSIB level to facilitate a capacity for orderly failure. So we'll talk about all of that work. In his previous life, Mike was also a partner in crime with Tim Clark over at the Fed.
Partner in compliance.
Partner in compliance. Thanks.
Obviously, the failure of a domestic, systemically important financial institution would be quite challenging. The FDIC has some good experiences, bad experiences, and learning from this. And I think it's no surprise that a CFPB director is worried about the failure of an institution with an enormous footprint in consumer and retail banking, a very large number of accounts, and the regional impact or national impact of its failure. Other points of concern for me, one is obviously the undesignated non-bank systemically important financial institutions. The Financial Stability Oversight Council has not designated any in quite some time. And I think many experts agree they exist, and we do not have resolution plans for them. That would make resolution very challenging and create an enormous amount of complexity. And of course, the work that the acting chairman has mentioned about the GSIBs, there's no victory to be declared. There are still a number of complexities. And of course, U.S. law requires us to evaluate those resolution plans based on whether they can be credibly completed in a Chapter 11 bankruptcy, which I think many of us know as a fairy tale right now.
I'd also like to remind participants that the meeting is public and is being live. So let me just take a minute to set the stage for today, particularly for new members. As you know, following the 2008 financial crisis, Congress established new authorities for the FDIC to manage the orderly resolution of large, complex financial institutions whose failure could threaten U.S. financial stability, most notably Titles I and II of the Dodd-Frank Act. Shortly thereafter, in June 2011, then FDIC Chairman Sheila Bair convened the first meeting of this committee, the heart of the meeting today. Our resolution staff will discuss two topics: GSIB resolution planning under Title II and the need for public transparency, and the challenges and options for resolving non-GSIB large banks. Here, and as the chairman mentioned, we'll introduce and discuss the topic of transparency. The FDIC has a long record of fostering public confidence. Everybody knows if you walk into the bank and see that FDIC sign, your deposits are safe. And we really want to build on that level of confidence around the execution of our Title II authorities. In essence, what we're looking for from you is who needs to know what and when about our efforts to help build our public credibility and confidence. The second topic, the resolution of large banks that are not GSIBs, is really new for consideration by the committee. In this session, we'll seek your input about the work we're doing and the challenges this work presents, which are formidable, whether it's for the FDIC or the financial system. And in the third session, as mentioned, we returned to a topic that we briefly discussed with the committee in 2020, which is the challenge of resolution of CCPs. This topic is one that is on a lot of policymakers' minds globally, and a lot of work is being done and warrants continued consideration by the committee. And we look forward to hearing from our guest speaker, Sir John Cunliffe, and from you all on how we should go about being prepared and prioritize these challenges that we have.
This has already been mentioned by Chairman Grunberg and by John, but my comments up to this point have focused on banks and bank holding companies where we have the supervisory insight and the Title I work that we're able to use that to support a robust resolution preparation for those institutions. However, we also have responsibility for resolving non-bank financial companies if their failure threatens U.S. financial stability. And the work associated with the non-bank financial companies is more difficult, given we don't have nearly the same resolution tools or resolution engagement and insight with those firms. A common challenge that we discussed with you back in 2020 was the fact that the FDIC didn't have access to certain data that would be needed in the run-up to or during a resolution event for one of these companies. Another more specific challenge, which Jenny Traylor will talk about later this morning, is the fact that the non-bank financial companies are not required to submit Title I resolution plans. And as we've mentioned, Title I plans provide the FDIC with direct access to key information that would be useful in supporting a Title II resolution.
I think you've spotted the right problem, and that's the problem to make sure that a supervisor who holds on to his child doesn't hold on to the child far too long. And in Europe, we are trying to solve it in our institutional framework, a bit similar to what you do. We are participating in discussion of the supervisor, which for the banks under our remit is in Frankfurt under the ECB. And at the same time, we have them participating in our discussion. But I think it's a topic that you always need to keep just on your mind.
Now, a lot of resolutions are triggered by liquidity runs, right? So then the supervisor has no choice, right? But the key would be trying to get in before the run and the fire sale. That would be really a stabilizing intervention. So could you talk and the data coming in on what the actual capital of the institution is very lagged and incomplete, and asset prices are changing very rapidly. So could you talk a little bit about what would trigger the resolution before the liquidity run?
Yeah, I mean, I would say again for us, it's having those conversations. We bring resolution is a part of the process throughout. And so if we're starting to even notice that a firm is starting to experience some stress well before you get to an actual liquidity event.
In the GSIB SPOEs, right, there's RLEN, which is liquidity execution need, which is calculated daily, is shared with the supervisors. It's never been tested, so we can't say it's perfect, or that it would work in real life. But it's massively better and different from what we had in 2008. So I think that if a GSIB were to go into resolution itself, it would be pushed into the bankruptcy far before the chartering authority pulls the plug. And Arlen is what is going to tell you to do that.
To what extent, or how are you working or integrating the evolution of markets, particularly the treasury markets, into your analysis, given that, the liquidation of collateral is so foundational to both recovery and resolution for banks, non-banks, CCP, and every structure out there?
As supervisors of resolution, we don't naturally have insights. So we're not the Federal Reserve here, So, but it is an area where we've seen time and again issues occur and issues that affect our institutions. So we are looking now at building up our capabilities in those areas.
The goal here is really for these firms to be prepared for resolution, and frankly, prepared for take recovery action so they never get to resolution. Plans are great. Rohit noted earlier that the finding of credibility of a plan is a challenging issue. Credibility, frankly, of a plan for one of these firms to be resolved in bankruptcy, it would be a huge challenge.
For the committee. I think part of what the structure of CISR helps to do is address these twin problems. One is that without that integration, I think resolution risks becoming a paper exercise, the way it's kind of set up. And part of that is the second problem, which is it's very infrequent, right? So knock on wood, that's the intent. But part of that means that memories are short and people forget. I think that on a lot of these resolution issues coming out of the 2008 crisis, everyone was moving in the same direction because it was so present. It was omnipresent as an issue, both on the regulatory side and on the bank side. And as we get further and further from that, we've got new folks who haven't lived those things. Part of the challenge is not having it just live as an ivory tower exercise over here. And then we've got, kind of day-to-day supervision risk management over here. And I think part of that integration is key. I'd be curious to hear from others, like what else needs to be done to keep that front and center? Because I think this gets back to an earlier question about boards and audit committees. That's kind of the daily muscle within organizations. And I think it's very easy to just say, well, that was a long time ago. We've figured this out. It's all good. We can move on from here. I think that's going to be a perennial challenge, especially as we move forward and there's new risks that come up.
We're all creatures of our past. So when we go through all this resolution, even though we may be forgetting 2008, it still heavily influences everything that we do, that we think. I think one of the things that we should be really careful about is the next crisis won't be 2008. I don't know a lot. I just know that. I know that for sure. And 2008, whether we like it or not, there was a sign, there was a windup, there was a pitch, there was a swing, there was a ball flying out. There were a lot of balls that went out of the stadium. We sat there and watched them. The next event, there may not be a sign, a windup, a pitch, and a ball. It just might happen. And so in many of these things, I think we've got to accelerate our thinking because we live in a highly accelerated world. We also live in binary outcome events, and the event most likely will affect multiple institutions simultaneously.
Some of the instances that we're going to share with you today are any one of these, to your point before, any one of these could cause a crisis amongst our banks. We need to be ready all the time, and we really don't know when it's going to come, and it could come very fast. So we do maintain a heightened state of readiness. We do exercises both internally and with other agencies and globally. We have protocols and committees set up to constantly work through some of these things. We can't predict it, and we try to build our resolution tools so that they're functional and they'll work in any sort of environment, but we really don't know what's going to happen. But we try to maintain heightened state of readiness.
Big picture, how do we horizon scan in a more effective way? And how do we contemplate an economy that is substantially more open, right? You don't have the banking industry writ large as a choke point for the bulk of financial services delivery anymore. You've got open technology architecture, you've got open non-banks, you mentioned that a little bit. So as you think about continuing to shore up this section, which is super important, you know, it's sort of like a balloon. And the answer may or may not be, you know, regulate more, expand powers. But how do you think about, how can we think about under the powers that, you know, you all have in collaboration with the other agencies to identify and address these types of risks as they emerge? Because in the end, people are going to care about was the economy impacted by financial instability, regardless of where it came from.
John, you had mentioned right in your introductory remarks that the last time we met, you did not have the data which you needed for non-bank financial institutions. This is what the chairman generally mentioned about non-bank financial institutions. At the beginning, I gather you still don't have it. I've got to believe that this creates a problem not only for the you have no ability with the non-banks, but I would think adversely affects your ability to really supervise and plan for the regulated sector.
It's also important to underscore the legal mechanics of invoking Title II for a non-bank. Requires, I believe, supermajorities of the Fed board, the FDIC board, sometimes maybe even the SEC has to be involved, consent of the Treasury Secretary, maybe even consultation with the president, and with no real insight as to what is happening other than market signals. And to be able to go in again without a supervisory relationship, without a plan. And yeah, tough. But I don't know what Jim, John, others, if you want to share the thinking you have put into that scenario of how to navigate something like that. Obviously, it's like what Gary said, you don't even know. Well, what are you even going into?
Yeah, it's a difficult question. I mean, we do try. It's difficult. I honestly, it's so vast. Both the authorities, they're very broad authorities, and we don't know where the ends, the boundaries are fully drawn yet. I mean, there is some parameters that companies would have to meet, but you know, we're in a dynamic environment. And then, you know, as far as what the decisions are going to be made at the time, there's going to be several parties involved, and they're always going to have their own perspective. And we'll have to deal with those facts and circumstances at that time. It's hard to plan for that. We do hold conversations, though, with all the key turners to make sure everybody understands their roles and talk about issues. But it's difficult.
What do we need to be thinking about for the stakeholders, the general public, customers, counterparties, other people like that? We think about what message do these stakeholders need to hear, and it might not all be the same. And then we think about when we need to be transparent. And I know that there's going to be a temptation for people to say, FDIC should just lay it all out there. Say what you're going to do every step along the way, and that pre-commitment will help improve confidence. But we also need to be mindful of the need for FDIC to have operational flexibility to adjust to the specific facts and circumstances on the ground. We're thinking about creditors. How do you communicate with claimants, including about their claims determination? How will the losses be allocated on the Dodd-Frank hierarchy, which is different than under FDI Act and under bankruptcy? And then how will the claimants be compensated? How does securities for claims process work? We mentioned that in the 2013 thing that Betsy mentioned earlier. We're also wondering if we need to be more transparent about some of the accountability mechanisms that we have as well for the general public audience. We are required to remove culpable management. How would we go about doing that? Do we need to re-emphasize that in the Dodd-Frank hierarchy that compensation claims are subordinated to general creditors and that prior compensation could even be clawed back if needed? And then finally, there's the funding mechanism. What part of that would be most helpful to boost confidence? I do think that the OLF and using it as the big gift, it's not a gift, but the big tool that we need in Title II to help provide confidence. But what do people need to know to really get that? How important is it to explain the rules and the mechanics for the OLF? How money will get from point A to point B? How would we use targeted guarantees to allay concerns about excess cash use? There's a lot of questions here.
I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty-gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that'll charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So I'd like to take a slightly different view, and maybe a middle ground in the center. First of all, I think, Susan and Betsy, what you've done in the thoughtfulness here is extraordinary, and I want to give you respect for it. I do think there's more that could be put out in the public, perhaps not just on Title II, but also on Title I, in a way that isn't scary to folks. I mean, Gary, there's a timing question, right? We're at a delicate moment now, so if it goes out tomorrow, it might have a different impact than if if Susan and Betsy do their work and it goes out as we're moving out of the recession.
I think this is an incredibly important point. You see it, any statement that's made, whether it's made by a regulator or an institution, is going to be tested by the market.
Peacetime.
And we have to understand that. And I think that just putting the 2 points together, what you want to have out there today is something that when you make a statement in a time of stress, it provides that underpinning for the statement. And I think that's the way to think about the body of work that you have out there. And it's kind of a dynamic relationship for when you have to make a stabilizing statement.
I wondered whether there are some market tests of whether you're being heard. And I think about TLAC. So TLAC should respond to good and bad news about the institutions. And it's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be. That's And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices, this is similar to what Jay was saying, in the market that you can tell whether people understand who's going to be protected, who isn't going to be protected. It would be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen.
I might go further than that, Don, because I think that you look at the evolution, I think we have to sit down and talk to long-term debt investors and make sure that they, as a stakeholder group, fully understand bank debt today is not what it was before. It is not principal protected by design. And I think that expectation, I like how you started off, Betsy, like it's all about expectation setting. And I think that is absolutely critical. If that doesn't hold, this whole thing doesn't hold. And so I think it's one area to focus on. I do want to go back to something Jay said about stabilizing statements. In my experience, they're not stabilizing. If you have to make a stabilizing statement, you're in real trouble. And I think that part of that means that there's a lot of pre-work that needs to be done such that those statements aren't seen as a reach. Because if they're seen as a reach, the market sniffs that out in 2 seconds and actually has the opposite impact. And this is one of those big challenges, like what can be done ahead of time so that it's all going as planned, hands off the wheel. This is part of what we've been prepared for, because that's what builds confidence.
You just said very well what I was trying to say.
So I think the most stabilizing comments have not been coming from the FDIC. They've been coming after the CCAR tests. And so there's been a consistent approach now for over 10 years of pronouncements coming out about the banks, about how much capital they're able to return, how much stock they can buy back, what kind of dividends they can pay. And that consistency, the market understands that. Even the common public will understand that. They know how to read those headlines. I think what we talked about here with the FDIC's role of having this available for institutions, have it available somewhere. The professional markets understand it. But I think right now the more stabilizing factor is that we've had 10 plus years of reports on stress testing, on capital levels, on dividend levels, et cetera. And maybe we should think more about, is there a way to make that more transparent or eliminate some of the jargon, et cetera. But what you're doing, I think, is excellent work, but maybe should be more for professional investors and available to anybody.
There's a large number of deposit accounts that we would need to handle at the time of resolution for the largest banks, 10, 20, up to 40 million deposit accounts, and more complex account types than for smaller banks. So, pass the relationships and things like that would be harder to work through. And then, of course, large portions of the deposit balances are uninsured, ranging from 40 to 50% for these institutions on average. And then, just other challenges around receivership management, the receivership entity that the FDIC would be responsible for. It'll depend largely on the complexity of the complexity and scale of the assets that are left behind in the receivership. It could be significantly simplified if we're selling the institution or using a bridge, and much is moving to that. I should just note that in the event that we have to undertake a liquidation where everything stays in the receivership, the operational challenges are quite daunting in that circumstance. And then combine that with the fact that they're almost certainly going to fail due to a run on liquidity. There'll be an abbreviated runway, which will further reduce the time that we have to conduct valuations and to market the institution. I'm interested for any reaction before we move on.
I'm curious as to, it seems that to me that at this scale of failure, the likely cause is probably a macro event that's likely to affect multiple institutions at once. And I'm curious as to how you feel about your ability to collectively coordinate all of that, and how you think about the scenario planning about how what you do with one institution may impact what happens at another institution and kind of the knock-on effect of that.
Yeah, so that could be the case, right? There could be something particular that a particular bank is doing, and it's an idiosyncratic failure. But it could be a larger downturn, and there's multiple institutions under stress at the same time. The part of the, and we'll get into this in the next part of this discussion. Part of the challenge here is that there isn't a built-in strategy the way that there is for GSIB resolution. And the GSIB model, really relies on the resources of the institution, single point of entry, and we're relying on sort of maintaining operations that limits the resource need on the FDIC. Now, bridge strategies for a large bank can look a lot like that. The challenge is there's not a built-in exit. So, we try to focus on strategies that reduce the resource need of the FDIC. We can't control the timeline, but there is decision-making with the other authorities about when and which weekend institutions fail on. So, we would hope to not be resolving multiple institutions at the same time. But there's, significant challenges when multiple are failing at once. And then just to the latter part of your question about the impacts on other institutions, this is one of the reasons why we're really focused on the impact, particularly on uninsured depositors. Because if there's a resolution that's impacting uninsured depositors, and there are similarly situated banks, I think we'd be concerned about what the knock-on effects would be to those uninsured depositors at other banks who are seeing, haircuts occur at the bank that's being put into resolution.
Another deep dive, thinking about the uninsured deposits, which some of them might be hot money and some of them might be sticky, in the sense that if it's brokered deposits, it's hot. But if it's Joe's auto body shop making payroll, it's sticky. And so I would hope, as you're doing the good and careful thinking around this APNR, that there could be some data-driven analysis around that, because there's a lot of challenges to think through here.
Part of the way that we think about systemic risk is it's not necessarily binary. It depends on the scenario. And when one of these institutions is failing, if it's in the context of a wider stress, a regional bank, could be disruptive. So just, we've touched on a lot of this here, but just quickly, and how do we think about what's the right strategy? There's not a single answer. These are the broad, three approaches that we think about. But we really focus on the middle option here, the use of a bridge bank. We've talked about why a sale to a third-party acquirer would be a significant challenge. A liquidation would be extremely costly. For a bridge bank, one thing that we're looking very, very closely at is that there's a big difference between a bridge in which we can pass all deposits and a bridge in which we can only pass insured deposits. And if there are losses incurred by the depositor class, then that makes it harder to pass the least cost test and to pass all deposits. It also means that the franchise is probably significantly destroyed at that point. And then, importantly, a bridge strategy, that's not an exit. That's only half a strategy. You need an exit to have a full strategy. And so, while we focus on making the bridge itself feasible, we think about some of the ways that we could exit from a bridge. And certainly, being able to more readily break up parts of these institutions by lines of business, regional franchises, just sales of portfolios, and looking at that in advance, that's very helpful, and it could help with the multiple acquirer type exit. We think about, whole bank type exits, maybe over time, if there's time to market out of a bridge, you could have a single acquirer, you could have an IPO type exit. And if there's significant long-term debt, you could contemplate a bail-in type exit for these institutions too, where you're turning the institution over to its creditors. The problem is that, the FDIC is not going to want to be in a bridge for an extended period of time. And these institutions are very large. And so executing into those options could take a long time. And there's not a built-in exit strategy like there is for GSIBs.
Can I just throw in one comment goes back to something that Dick brought up, which was, is there a dividing line in terms of these systemic risk scores? One of the things I do worry about is sort of the continuity of the U.S. banking system. We've had our 8 GSIBs since they got designated. They stuck there. None of them have de-GSIB'd. And in terms of the other banks, they tend to be trying to stay within their buckets. And I worry that we've created some of these discontinuities, that there's no sort of ramp up, that you cross a line, all of a sudden you go into full Title I, planning full TLAC, et cetera. It would seem to me that there is no bright line that really just magically separates that bank that's a millimeter over the line from one that's not quite so much over the line. And that if I was thinking about a system that would work smoother, that'd be more future-proofed as banks want to grow and scale becomes important, that having some ramp into some of those capabilities that would give you options, whether to bail in on its own resources or help with a merger, that some sort of phasing in would feel like something that both solves a industrial structure problem as well as a resolution problem.
And I want to add to that I don't think that's just based on size. It's activity based, it's broker dealers, it's international activities, it's asset management, et cetera.
I think that's right. To Sandy's point earlier, I mean, if you just look at the GSIB scores and the sizes, there are many regional banks that are larger than some of the GSIBs, and that's because a lot of what's scoring there is the complexity of the activities, the cross-border activity, and breaking into that type of activity isn't something that the regional banks can readily ramp up into. So I think that might be part of why you don't see as much movement there. But it's definitely not just size. Size is important to us in terms of just who can acquire, if you just look at it from a strategy perspective.
I'd like to give you all a brief break. Sir John Cunliffe. I suspect some of you may know John. He serves as the Deputy Governor of the Bank of England for financial stability. He's also chairing, as Jenny mentioned, the Committee on Payments and Market Infrastructure for the BIS. He's really been an international leader on payment system issues and has particularly focused international attention for several years now around the risks related to both the supervision and the resolution of central counterparties. I think of all the issues relating to the resolution of systemic financial institutions since the 2008 crisis, this is the one that really stands out as clearly of profound systemic consequence in which we've arguably made the least progress. John, thank you so much for joining us today.
Look, thanks, Marky. First, just to check whether I'm audible and visible.
Yes, both are true.
Okay, thanks. And secondly, an apology. It's a privilege to get a chance to address this group, and I would have liked to have been there in person. But I have a meeting tomorrow morning in Basel, which will, among other things, talk about the work plan for CCPs and non-default losses and the like, and made it just impossible to be with you. So first, why does it matter? Well, as we know, CCP's role as central nodes in the financial system have made them, if they're large enough, naturally systemic, and they protect key markets from counterparty credit risk. And we saw what a failure in that area could do during the great financial crisis. And by mandating use of CCPs for some key financial derivatives after the GFC, we've made some of them even more systemic globally. For example, 60% of credit derivatives are now, swaps are now cleared centrally as opposed to 10% before the financial crisis. 85% of interest rate contracts are cleared by CCPs, whereas it was about 40% before the financial crisis. And of course, that's just the proportions. The actual quantum has grown as these markets have expanded pretty significantly. But we can't ignore the concentration of risk and the failure of a CCP and the effects that would have, and it would transmit stress quite widely throughout the financial system, and it would remove the protection against counterparty credit risk, which I think is essential for markets to operate. So we do need to find effective ways to manage a CCP failure, and because the concentration effects exist, it means actually that there are returns to concentration in being a CCP, which means many of these businesses are global and they need international standards in the same way as we need international standards, strong international standards for the resolution of globally systemic banks. However, and it's an important point, CCPs are not banks, And the design of any resolution framework, I think, needs to reflect some of the essential differences. The first and most obvious, the risks they run are very different. They don't do maturity or liquidity transformation. They don't have complex balance sheets with asset and liability structures and mismatches that need to be resolved. The two risks they face essentially are counterparty credit risk, and I'll talk about that, and operational risk of some sort of operational failure. On counterparty credit risk, I mean, this stems from the default of one or more of their members. As their function is to be the central counterparty, in other words, to stand between the two parties to a trade, they really have to ensure at all times that they have exactly offsetting contracts with the buyer and the seller. In other words, they have to maintain a match book at all times. And if one of the counterparties defaults, they need to be able to absorb the losses that will probably be necessary to restore that match book by finding contracts to offset the contracts that have been lost. Now, unlike banks, they don't hold capital really to absorb loss-absorbing capital. Rather, under their rule books, they can effectively pass losses without limit back to their clearing members. First, they do that, and I think the previous speaker mentioned the waterfall of allocation of losses. First, they do that by using the pre-positioned resources of the defaulting member, and then they start to mutualize the losses by using the pre-funded default fund to which all members contribute. And then when the pre-funded resources run out, they have the ability to make cash calls on the remaining members. And then after that, they can start to haircut the margin they owe to some of their members. And finally, they can tear up some, or if necessary, all of the contracts they have with their members. So actually, unlike banks, when it comes to default losses, CCPs can't go bankrupt. At the end of the waterfall of recovery actions, they just tear up all the contracts and effectively the clearing service disappears. And I should say that if you follow the rule book, the equity of the owners is untouched in that process. But of course, from a financial stability point of view, those clearing services are important, and tearing up of contracts removes the hedges that counterparties will be depending upon in a stress. So the CCP service needs to be kept operating, and the transmission of stress needs to be kept to a minimum. My first point is it is imperative that the resolution authority can step in and take control before CCP recovery actions are exhausted. I think the earlier speaker made the point that you want to ensure that when you get to resolution, the resources or the options that are available haven't effectively been exhausted. So for us, one key issue is the resolution authority needs to be able to step in on failure or the likelihood of failure before the recovery actions have been taken too far. So the current UK regime, we have a regime, we've had one in place since 2013, has many of those features, but it doesn't have them all. And the legislation that's now going through Parliament, I think, will give us all of those powers to operate ex ante, to require resolution plans, to remove obstacles to resolution, to step in when we need to step in, and then it will give us in some areas some extra powers that don't exist in some of the CCP rule books, and it will enshrine that no creditor worse off provision in the way that I described it. This raises the question, though, for default losses, is do we need extra pre-funded resources either in recovery or resolution? But there's a big caveat in all of this, which is in a stretch in which, say, 3 to 4 of the biggest clearing members fail, we may find that actually those liquidity resources aren't available for the other clearing members, and this could make the stress more stressful. The only point I'd make, though, is if we're in a stress in which 3 to 4 of the big clearing members fail, and remember that's not just in one CCP, that's across the board and across the financial system. And if the resolution, so we're talking about potentially the failure of, say, 2 to 4 GSIBs, and then the resolution arrangements for those GSIBs has also failed because resolution would enable them to continue to meet their obligations to a CCP without default, I think we're going to be in a pretty heavy systemic crisis, and bail-in bonds and the resources that they might offer even if it's a full reload of the default fund, may help, but they're unlikely to be able to resolve the systemic issues that we face. There are costs for which we need to recognise. I mean, just a simple thought experiment back of the envelope. If a CCP issued bonds equal to the default fund, so it would have a full reload in resolution, the annual coupon of that could be equal to or greater than CCP capital, and those costs, of course, are likely to get passed back to users, raising the costs and reducing the incentives to clear. So one needs to think about what benefit in that sort of systemic stress you would get from this against the costs and the disincentives to clear in business as usual. Of course, jurisdictions are different, and there could be jurisdictional reasons why one might want to go at least some distance down that route. I mean, in a world where the resolution authority either doesn't have the line of sight or can't effectively or quickly step in before the resources that are available in recovery are exhausted, or where the resolution authority is not able to plan for CCP resolution and sort of comes in and has to deal with a very complex situation without there being a plan or sufficient advanced knowledge, or where CCP rulebooks are either they don't provide sufficient options, or actually there are obstacles to resolution there which can't be cleared away. In those circumstances, one might argue, well, a reservoir of pre-funded resources that can be accessed only in resolution might be necessary to enable the CCP clearing service to continue to operate. And the next stage of the FSB work, I hope, will look at these issues and maybe tease them apart and give us a better line of sight. And finally, and I'll stop very shortly, I should say a word about non-default losses, because in a way, these are equally, if not more worrying, because the position is very different and the CCP recovery actions are very limited, and the capital to absorb these losses is pretty limited as well. So the resolution authority in that case will not be able to depend on the waterfall. It will need to have access to some other resources. So in the UK, the new powers that we hope will be approved by Parliament will give us the power to make a cash call. We're thinking of something, the proposal we put out there is 3 times the default fund to cope or to absorb the losses of non-default losses and to recapitalise the CCP. And of course, in those circumstances, there is no creditor worse option, protection that protects the equity. And so the equity of the CCP would be wiped out. We need to think about what then happened to ownership and whether the CCP was passed back to the members. But we feel it very important in the UK that as a resolution authority, we have access to resources to deal with non-default losses.
Thank you. That was a terrific overview. You didn't mention one of the differences from a bank resolution that strikes me as very important in this case. In a bank resolution, we can hope at least to have a resolution weekend. It strikes me that with a CCP, you have almost no time to intervene and try to take control the situation, keep it from deteriorating quickly. How do you deal with that much shorter time for action?
I think you may be on mute.
I've been unmuted, I'm sorry. Look, that's a real challenge. And in the circumstances which this is happening, and say 2 clearing members, the largest 2 clearing members have defaulted, prices will be moving very fast in markets. So you'll be in a situation of general stress. I mean, to my mind, it makes the case for the resolution authority to be closely involved with the business of the CCP, for there to be close cooperation between the CCP supervisors and the CCP resolution authority. It's easy for me to say that because in the Bank of England we look at these things in an integrated way, but also the resolution plan has got to have fast stabilisation. That said, some of the defaults we've seen in the past, CCPs have been able to go through that default waterfall quite quickly. I'm thinking of Lehman Brothers. So the Lehman Brothers default there were large positions held, certainly at the London Clearing House, and those positions were closed. They were auctioned off, the losses absorbed in the middle of a global stress, if you remember, the losses absorbed and people paid out very quickly, whereas the non-centrally cleared contracts took years to work out in a bankruptcy. But look, it is a challenge. I think what we'll do in the UK also is we will do some dry runs and some kind of resolution testing. I think though, once the resolution authority steps in, we haven't had to do a big resolution in the UK, I'm pleased to say, but once the resolution authority steps in and says, look, we are now in charge, we're taking over control of the rule book and the actions, I think that might also have a stabilizing effect. But ex-ante planning, wargaming, knowing where your tools are and the risks, I think will be essential. But it will be quite a stress period if we have to do it. One last point on that, which I get told off for saying it, but I'll say it anyway. When you talk to the CCPs, they tell us that the pressure they get from their members is to charge less margin, to reduce the cost of trading all the time. And the like. When you talk to the clearing members at very senior levels, they say they're worried about the risks in CCPs and the fact that they are exposed to these risks, both the neutralized default and the non-default, and they don't have kind of enough influence on the CCPs. I think some of the answers to this lie in the clearing members, and actually whether the risk control impulse in the clearing member outweighs the can I do this trade as cheaply as possible impulse in the clearing member. So there are some issues there, I think, for clearing members as well. Sorry, you had a second question.
Yeah, I think just a couple things. I think on the governance, I think you nailed it there. And I think, if you see many of the writings and, the acting chairman mentioned them by both buy side and sell side, I think there's just a very clear drive by global industry, and I'm no longer in it anymore, to actually build up front resources because you want them to be predictable, manageable, and understood. Yet it seems really hard to get there. And I'm just curious as to your viewpoint, because it seems like, our regulators are aligned, our academics are aligned, the industry wants something, yet we are not there yet. And I think upfront is the way to go, and inclusive of bail-inable debt, except I would just offer, rather than shock absorbency, that's really a recapitalization mechanism, right? Because then it moves from a demutualized to a mutualized model, which is probably a more appropriate model, but that's just not where we are at the moment. So I guess my question is, why are we collectively having a hard time if everyone says they want more pre-funded, they want TLAC, they want better collateral, they want more appropriate through the cycle margins? So I'd love your view because I certainly can't figure it out.
So first of all, I think to the extent that CCPs compete on margin, and they shouldn't, so I don't know if they do or not, but the extent they do, that's because they're under commercial pressure from their clearing members. And when you talk to them, particularly for clearing services that are contested between different CCPs, we certainly get an awful lot of reports that they are basically under pressure because their clearing members will go to the cheapest option. And of course, pre-funded resources cost money, but there are other things that cost money in terms of margining as well. So I'm not sure it's quite as one-sided as one thinks. And of course, the cost of bail-in bonds, as I say, so I think the default fund of the London Clearing House is around 10 billion. I don't know what the coupon will be on a bail-in bond, but that cost, particularly where there's a clearing mandate and you're legally obliged to use a CCP, and I don't think any of us want to get into the economic regulation of CCPs, although maybe one will have to go there one day. Those costs are going to come back to members as well. So I don't see this as such a one-sided set of issues, to be honest.
It was interesting, the contrast between the Bank of England. I got the sense from our earlier discussion that most of the progress we've been making here is procedural. You've got a lot of people talking together and building understanding that we didn't have before. But substantively, where do we stand here in the United States if one of these units were to get into serious trouble? Do we have the capability to deal in a timely way?
I'll be glad to respond, but I'll give Jenny first crack.
Sure. So I mean, we've highlighted a number of the challenges today, including that the runway is likely to be short. So I think that we look at the existing planning that we have, our existing authorities and tools. We talk a lot about the procedure of the way we work with the supervisors and the other authorities, because that's how we build our understanding and our information. And so we do look at individual firms and we do build on that planning. But, we acknowledge that there are challenges and there's more work to be done there. Data, I mean, there's a lot of things that we've highlighted. I think ultimately the strategy for a CCP resolution isn't that much different than what we would attempt to achieve for other institutions, in that you're trying to preserve those critical operations for the market. And so if there was we would look to move those critical operations into a bridge institution. And so the work then goes into how do you operationalize that? But the strategy isn't so much different. It's just all the sort of the unknowns and the information that we need.
If I can comment, and it really goes to the broader issue that was raised earlier about the gap on the resolution side relating to non-bank financial companies, of which CCPs are, in some sense, the ultimate example of a systemic non-bank financial company. And the fact is, this is my perspective on it, that the Dodd-Frank Act really put in place a coherent framework of authorities for the agencies to deal with the resolution of a global systemic banking organization. We don't have the framework, the infrastructure in place on the non-bank side. And that's why this is on the agenda for today's meeting, because I think looking at the post-crisis world, this is probably where our attention and priority needs to be. CCPs are the prime illustration of this. We don't have that coherent framework. We've really built what I would consider to be a fairly credible framework, which hasn't been tested yet in practice. We have not yet executed it. So I have that caveat that until we do it, I'd be a little cautious, about what representations we make.
And just to follow that thought through, if you're a clearing member, you're not allowed to operate out of a CCP. If you're an end user, you can go, but who you're going to trade with, because there's no market depth. So these are, again, if they're predictable, manageable, it can be done. Those pieces need to be closed down. And the last bit I think we should carry on thinking about is who has some of these extraordinary tools, who can enact them, like variation margin haircutting, and for those who may not be as familiar with it, and I'm sorry to say I am as familiar with it as I am, that would be the equivalent of in a bank resolution resolution plan saying, we are just going to haircut your deposit in order to survive. That wouldn't exist anywhere else. So if we're going to think like that, who does that and for how much? Because that might be perfectly good in recovery for a recovery and resolution authority to do. But I would question that in the hands of the management of the CCP that has taken it into this place. And again, sort it out, it seems to me. So really, please keep doing this really important work so we can finish taking it to the hoop.
Thank you. Anything else for today? Well, thank you all. This has been a very helpful discussion, and we appreciate you all taking part, and we'll do it again next year. Thank you. And we'll have lunch upstairs.